Hello and welcome to WM Today, Wealth Management Today's YouTube channel. My name is Craig Iskowitz. I am the CEO of Ezra Group, a management consulting firm in the wealth management and surrounding fintech space. And with me today is Michael Kitces. Hi, Michael.
Hello, good to be here, Craig.
Michael is a partner and the director of research at Pinnacle Advisory Group. He's also co-founder of XY Planning Network and the publisher of the Kitces Report and the Nerd's Eye View. And today we're going to talk about financial advisor fintech. On a monthly basis, he publishes a fintech column, and we're going to go through a couple of the news items and interesting developments and truths that Michael's identified in the fintech for financial advisors. So,
Absolutely.
Mike, I wanted to start off with fintech mergers and acquisitions.
Yeah, it was a busy month for M&A activity in advisor world. Unfortunately, not all the good kind of M&A. There was a little bit of the bad kind of M&A of companies that were, I think, struggling a little bit and needed an exit. But a lot of activity in the past month.
And what I wanted to know is, do you see this as the first wave of consolidation in this space, in the robo-advisors and financial planning and all these little point solutions?
You know, I'm not sure this is really any tip off to the front end wave yet. You know, for better or worse, I think a lot of these were companies that just they were either experimenting with some new directions or some crowded spaces that were just a challenge. Advice Q was in the world of trying to facilitate advisor lead generation by distributing media content that advisors wrote, and you know, unfortunately, the reality is it's hard to clients from writing consumer media articles because it's hard to differentiate and stand out. And you know, ultimately, the suffering of advisors trying to stand out, I think, became Advice IQ's problem of making them stand out and made their business model a little harder. You know, WealthMinder had a different angle, but was kind of similar. They were working on direct-to-consumer lead gen for advisors with a client portal, and you know, figuring out advisor lead gen continues to be a very challenging problem. So. WealthMinder had some pieces going for it, which was part of why I think Advisor Engine acquired some of the tech that they built. But you know, whoever it is that figures out that digital advisor lead gen at scale business opportunity is going to have a fantastic business, but it continues to be a hard problem. Right. And Prairie Smarts was in a pretty crowded space on risk management and risk analytics, and I think arguably had some very interesting sophistication to their tools. I don't think they struggle in kind of the merits of their technology, but there's certainly a challenge right now for startups coming into the financial advisor fintech space, which is just getting distribution to advisors to a critical mass level is no small feat right now because we're so fractured. So it's very hard for new entrants to get to their moment of critical mass.
Indeed. So you just mentioned with all this M&A that there's some good M&A and then there's some not so good M&A, or maybe some bad M&A due to companies trying things that didn't work, or they were in crowded spaces. So is this a positive reminder that there's hunger for fintech, or is it a negative reminder that there's too many firms and they're trying too many things?
No, I still view it as a positive and not a negative overall. I mean, at a minimum, it's a reminder that, you know, even if you build some technology to go into a new part of the advisor fintech world, or even come into a crowded advisor fintech world, there are plenty of players out there, which means that there are people that will buy you out. You may or may not get like kind of the exciting high value exit that you were hoping for, but you know, certainly there are a lot of other industries where the tech comes and the tech just vanishes, like they just fold shop and walk away because there's no terminal value to the software. And I think a lot of what we're seeing here is you know, a lot of acquisition ends up happening because companies with more capability or distribution potential buy the tech because the tech was valuable and they've simply got more in size and scale to distribute it. And to me, that's the kind of thing you see up and down the line, from WealthMinder getting acquired by Advisor Engine because they think they can bundle the WealthMinder financial planning software into the Advisor Engine and what it's trying to distribute into the channels. More up the line to deal BlackRock acquiring Future Advisor, You know, they didn't buy the company for whatever's 50 times revenue because they were excited about the B2C potential of Future Advisor. BlackRock bought it because they said, look, we got a massive distribution capability in the advisor world. Your technology isn't working very well in a B2C distribution, but I've got a different way to apply your technology that creates more value. And so I think that's just part of the entrepreneurial dynamic, of course, that when you're trying to build new software, you need to get a good viable product, you need to find a market where it fits, and then you still have to actually figure out a distribution strategy, particularly in a very fractured marketplace like the advisor world. And so there are companies that maybe figure out some parts of that and not all of it. And to me, the opportunity here and part of what you're seeing is, if you can come up with some good tech, there are other people who might have either a different market to fit it to, or if you even have a good product to a good market, they just may have more distribution capabilities to help make sure that it actually gets out there and goes to market. And so I view a lot of these as the tech is just getting reconfigured to another location in the ecosystem. But it doesn't go away, it doesn't vanish, because again, I think there's still a tremendous hunger for more and better technology, including, frankly, a lot of incumbents I'm finding that seem to be taking the position. We know we're not great on innovation, but we also know it's a very hard marketplace to gain traction, which means there is time and opportunity for us as incumbents to watch some of this startup activity and then to go acquire the ones that are gaining traction.
Michael, you just mentioned BlackRock acquisition of Future Advisor, not because of their B2C potential, but because of BlackRock's distribution. We've also seen Invesco purchasing GemStep, which you could say, for the same reason, they also have distribution.
Absolutely.
Is that a conflict of interest, that you've got firms that are supposed to be looking out for the best interest of their clients, although they're not; these are not exactly the same business models, but then they've got a parent that wants to push their product out the door?
Well, I mean, is it a conflict? Like, yes, absolutely. I mean, but conflict is another way of saying distribution channel to me. When you're out to sell your product, you're selling your product. You're not trying to give like the person the most objective advice about the best possible product on the planet. You're there to sell your product, and so product distribution is inherently conflicted. I think that the dynamic that you're seeing play out, though, is simply this recognition that robo-advisors are a distribution channel, and that to me that was sort of inevitable. Once you take a platform that shows up that says we're going to try to gather consumer assets, manage them, but we're going to buy third-party products, right? Because when Betterment and Wealthfront and Future Advisor first showed up, they were all buying, third-party publicly available ETFs. I actually had a bunch of consulting clients working with that were asset managers back in 2013, 2014 that were trying to figure out like what's their robo strategy. And the discussion I given them was like, just think of it as another distribution channel. So watch it, figure out how you can get your funds or products into it, and if it gains traction, you may or may not want to go buy one. And so I think ultimately what the turning point was for this space was when Schwab launched. And when Schwab launched Intelligent Portfolios, what was distinct about the Schwab Robo was they fully validated as a distribution channel, because they rolled out Schwab Intelligent Portfolios and it had something on the order of about 70% Schwab ETFs, and they brought in $10 billion in a year or so. And so like people commentating on robo-advisors said, oh my God, a robo got $10 billion. But the real notice of Schwab was the rest of the asset industry that said, oh my God, a product manufacturer collected $10 billion, or I guess about $7 million into their product by rolling out their own proprietary robo distribution channel. And I think that's what ultimately kicked off this buying frenzy of activity, saying, well, I got ETFs, so I'm going to find me a robo distribution channel. And so then all of a sudden the acquisition activity kicked off. BlackRock is, to me, no great surprise, the biggest the biggest asset manager out there, the biggest ETF player. So they made the biggest splash and paid a first to market premium to try to get out into a robo distribution channel. Then you saw others coming in. It wasn't Invesco buying GemStep. It was Invesco, maker of PowerShares ETFs, that bought GemStep. And now you've seen additional acquisitions of robo-advisors by asset managers and product manufacturers. That to me is all about just this recognition that it's a distribution channel. Now, the challenge I think a lot of them are still finding is it's not an if you build it, they will come distribution channel. That was what the robo-advisors learned the hard way, and that's what a lot of the others now I think are struggling with as well. Even for Schwab's success, it wasn't just, hey, you roll out a robo, you get $10 billion. It's, hey, into your proprietary products. It's, hey, you roll out a robo and do a bajillion dollars of consumer marketing with a nationally recognized consumer brand, and
Sure.
you can drive some assets.
And
And
it's just that
so,
easy.
my gut is a lot of these acquisitions, frankly, are going to turn out to be heartache for a lot of the firms that acquired, because virtually no robo-advisor, like they were a hypothetical distribution channel, very few actually had traction. And so buying a channel that has no actual distribution attached to it means you just end up spending a bunch of money that doesn't work out well.
Sure.
But the comment I had made when Future Advisor got bought was, this is a bad sign for the space, because this is the highest price point any robo-advisor is ever going to get bought for.
So seeing that the 250 is a high watermark for the M&A and
150.
robo-advisors, 150, sorry, then shouldn't these other firms be looking at that as saying, if we can't exit for that much, we're not going to be able to exit and make back our money? So is that driving decisions now?
Yeah, when you get down to the few big players remaining, which is basically Betterment and Wealthfront, that already long since had valuation levels that were much higher. Yeah, they're kind of painted into a corner now where it's go big or go home, and I think that's why you see both of them pushing the way that they are. John Stein has not been ambiguous about saying they view their endpoint as they want an IPO. They're the viable exit to get an upside from where their valuations have been already. And Wealthfront's taking its own version of the strategy, which is, all the other robos are pivoting away, so we are going all in on AI-driven, no human robo advising.
Sure.
And personally, I'm very skeptical that that's going to end up being the successful path. But I mean, I respect it, frankly, from a business decision perspective and a game theory perspective, because I think Andy Ratcliffe comes at this and says, look, we can't get to the numbers and the valuation we want by pivoting the way that everybody else has, because the numbers already aren't adding up. The product market fit is not as deep as what everybody thought with the early traction. And so if you want to have a shot at still turning this into $1 billion company, almost by definition, for what we saw out of BlackRock acquiring Future Advisor for just $150 million, you cannot get $1 billion exit by just being the robo that everybody else is, especially when you're running second place to Betterment. So their only choice, you have to find a way to make your mark in a unique way. And as we know, like the Silicon Valley mentality is, the more people that tell you it's impossible, it can't be done, the more valuable the business opportunity must be. So we're going big and going home, or going home on it.
Do you ever read Tim Ferriss?
Yeah, a little bit of work, a little bit of his work.
Yeah, he was one of his interviews, I forget which podcast was, they were talking about exactly that. If you have an idea and everyone says that's a good idea, it's a terrible idea. If you go, that's a crazy idea, that's the idea you want to run with. It's got to start. If you want to be innovative and change the market, people have to think it's crazy.
Yep. And so I think that's sort of, for better or worse, that's the path that Wealthfront now is really committing itself to. And frankly, venture capitalists know that it's risk-based capital, and there's you can, granted, at some point you have to have a company that goes off successfully, but Andy has a history of doing that successfully. There's no shame in Silicon Valley of saying, like, we had a big idea and we made a big run at it, and it didn't quite work out, and people move on. That's just part of the fail fast, fail forward entrepreneurial mentality. And so I think they're just living and embracing that. But once you get past Betterment and Wealthfront and the Future Advisor, when you get into that whole kind of secondary tier of players, I do think you're seeing a landscape where, I mean, the tech still has value, but just if you're from the entrepreneur friend, if you're creating that company, you need to be really careful about how much capital you raise, what you set targets to be, and how big you can realistically grow.